All right, so some breaking news in the mortgage and real estate world today. We didn't expect there to be much news for July and August, but lo and behold, here we are. And CMHC has announced that they are going to ease their underwriting rules effective immediately after their June 2020 changes, which made their underwriting guidelines a little bit more stringent, turned out to be a big mistake, ultimately costing them a significant amount of market share. But before we get into what all this means for you, do me that favor, hit that subscribe button, hit that notification bell, please hit that like button so more people like you can see this video. And don't forget about our race to 25,000 subscribers, where one lucky winner is going to win $5,000 to put towards their RESP, their RSP, their TFSA, to pay down their mortgage, to pay down their debt, or simply do whatever they like with. But in order to win, you have to subscribe to this channel. So go ahead, click that subscribe button. It's free, it's easy, and it's definitely worth it. The definitive guide on how to manage your credit, product, penalty, price in that order. It's never been more important to get your mortgage right. Okay, so let's get into it. Let's discuss CMHC easing their underwriting guidelines back to pre-June 2020 levels. And just to recap this whole thing, let's talk about what happened last year. First of all, we had the pandemic. That started the whole thing. And CMHC quickly came out in April and said they expected that the Canadian housing market will lose 19% of its value based on what was going on with the pandemic and happening in the economy. Now, obviously, they got this completely wrong. And Evan Siddall, the former CEO of CMHC, had been somewhat bearish on Canadian real estate for quite some time. Obviously, the predictions were completely false when you have somebody who's leading an organization who believes that all doom and gloom is coming. That tends to drive the predictions and the policies. And obviously, as an insurance company, CMHC, and a federal company, CMHC has an obligation to make sure that they're protecting Canadians, protecting the market. Obviously, they made errors in their predictions. And in July, as they saw the housing market heating up, they said, hold on, this is getting a little bit too hot. We're going to change our underwriting practices. And as often happens in the real estate and the mortgage world, when a big organization like CMHC makes a change, they typically expect the rest of the industry to follow. And that didn't happen. This is very similar to back in the, let's call it the somewhere between 2010 and 2015, TD decided not to move their prime rate with the Bank of Canada's change in interest rates. That's why TD has a prime rate that is 15 basis points higher than all the other lenders, at least a mortgage prime rate that is 15 basis points than all the other lenders. TD obviously made this change way back in the day, expected the other lenders to follow. They didn't, and therefore it led to reduced market share. Well, same thing here. CMHC made a big change, and typically what happens is when one insurer makes a change, the rest tend to follow. There's two other ones. There's Sagan and Canada Guarantee. Sagan and Canada Guarantee in this case looked at their risk modeling and said, we don't believe that we need to change our underwriting practices. So what happened back then was they reduced the debt servicing ratios, which what debt servicing ratios is the percentage of your income that can go towards your mortgage and to all of your other expenses. They reduced these fairly considerably last year to 35 and 42% respectively, I believe. Previously, they were 39% of your income could go towards your housing expenses and 44% total could go towards your housing expenses combined with all of your other debt. This is what CMHC is walking back to effective immediately. So CMHC here, you can see it here, will consider a gross debt service ratio going forward of 39% for the gross debt service ratio, which is again the housing costs, and then total debt service ratio of up to 44% for borrowers who have strong history of maintaining their payment obligations. So this is for people probably who have over 680 beacon scores. So, really interesting news in the fact that CMHC is basically acknowledging the fact that the changes that they made last year had a significant impact on their business, and it was the wrong move at the time. Now, there's a couple other things that are coming out here because they are also putting in a minimum beacon score of 600 for at least one borrower. Now, prior to now, that minimum beacon score has been 680. 680 used to be what constituted a credit score that was worthy of pretty much the best insurance products and the best debt servicing ratios. And then last year, CMHC said, no, that's going to be our minimum going forward. Well, now they're going back and saying 600 is now the minimum. Now, this is interesting because if memory serves me correctly, 620 was the minimum beacon score prior to June 2020. So what I believe CMHC is doing here is they're actually reducing their beacon score down to 600, because typically the other two insurers like to see 620 beacon scores in order to create a little bit of a market advantage and therefore gain some more market share. In the past, and I can tell you this unequivocally, in the past, CMHC was the easiest of the insurers to deal with. And when they made these changes back in June 2020, they became one of the most difficult to deal with. In fact, very few of our clients ended up with CMHC insurance last year because lenders simply chose to get the mortgages insured elsewhere. Now, CMHC is also saying that, as always, they will consider the overall strength of the deal. So obviously, if they don't believe that a client will be able to repay their loan, if they don't believe that it is a strong applicant, they're going to reduce the debt servicing ratios or try to increase the down payment. We've seen them do this in the past, where if a client meets their guidelines but isn't necessarily super secure in the type of job that they have or the industry that they work in, then they have said basically we're going to require 10% down rather than 5% down. But just a really interesting conversation around CMHC making a decision that back in July or June of 2020 was designed to hopefully have Sagan and Canada Guarantee follow suit and then ultimately decrease purchasing power by about 11%. And obviously, with Canada Guarantee and Sagan not following through, this didn't decrease purchasing power for insured borrowers at all, because simply put, the lenders chose the other two options rather than CMHC. And ultimately what ended up happening was CMHC's market share decreased. And here's the problem with that, is if their market share decreased, what that means is less revenues, less insurance premiums, and a less sustainable government organization with respect to mortgage insurance. So this is, I think, a prudent change, something that they have to do, something they have to do quickly, something they have to do now. They've missed out on a lot of business in the last year. They've probably missed out on some of the best business that they will see and the best opportunities that they will see in probably the next 5 years. Obviously, that busy market where premiums were being paid quite frequently reduces the amount of premiums that CMHC was able to garner, and also opens up their risk by virtue of the fact that they have less in the coffers. So I think that them doing this now, doing it when it's prudent, and doing it now that Evan Siddall is gone and no longer guiding the ship, because obviously the speed of the captain is the speed of the ship, and having somebody who isn't necessarily as negative around Canadian housing running the company and running the insurer is probably a good thing overall for Canadians and for CMHC and lenders in general. So here's what we hope happens. We hope that more mortgages are going to be sent by our lender partners to CMHC. We hope that they're going to have, obviously very good underwriting practices, but also very, very, very discerning underwriting practices, so that they aren't risking the CMHC portfolio on behalf of all Canadians. And at the end of the day, what we hope is that this brings CMHC's market share back to some normalcy. There is some benefit to having the government organization having the biggest market share and having them be in the strongest position of the three insurers. And I hope that that is certainly what we end up with at this point. So here's what this means to you if you're buying a house in Canada. If you're buying for under $1 million, you can do so with 5% down on the first 500,000, 10% down on everything over and above that, up to $1 million. You can now do it with CMHC with 39% of your income going towards the housing costs and up to 44% going towards all of your other debts. So your things like your credit cards, your car loans, your unsecured lines of credit. And what it means is that now you have a third option when it comes to getting mortgage insurance. So if Sagan or Canada Guarantee doesn't like a specific property or doesn't like something about your particular application, you've now got more options, which is a really good thing, because we're still seeing people out there which are against our best advice, writing condition-free offers, finding themselves in situations where they aren't able to get a loan because Canada Guarantee and Sagan are saying no, and CMHC previously had lower debt servicing ratios, which led to clients not being able to get the mortgages that they expected they would get. So if you found this video useful, We have a home buyers boot camp if you're in the process of purchasing a home. Highly recommend that course. Part of my why is to make sure that all Canadians have the information that our Mortgage 360 clients get. We understand that not every client can come to Mortgage 360. Sometimes they have their own broker, they have their own bank. That's fine. What's important to me is that you get the best information in the industry and that you're able to do so or able to purchase a property from an informed place. That's why we created these courses. They are so low priced that anybody who's looking to get into the market can easily purchase these courses for a very, very, very reasonable cost and get 10 to 50 times the value back over and above what they paid. In fact, I've made it so that if somebody purchases that course, they will be guaranteed to get at least 10 times their money back because we put in a special offer from Mortgage 360 to ensure that that happens. So I put a link in the description below. Would love to join you on that journey, whether it be through that course or whether it be through doing your mortgage by applying through mortgage360.ca. We service across the country, whether it is in provinces like BC, Saskatchewan, Alberta, and Ontario, where we're licensed, or referring to other great agents in other provinces that operate in the very same manner that we do. And ultimately, if you found this video useful, do me that favor, hit that subscribe button, hit that notification bell. Please hit that like button so more people like you can see this video. And don't forget about our race to 25,000 subscribers. We'll see you on the next video. Cheers.